Welcome to Less Than 15, a show for busy business owners brought to you by DFK Australia, New Zealand. Each week we deliver bite-sized, actionable insights from industry experts so you're across the issues that really matter. I'm your host, Angela Rasmus. Let's dive into this week's topic. Welcome to the latest episode of the Less Than 15 podcast. And today we have a guest from our Perth office, Steven Tindale, who is a partner in business services and advisory at DFK Gooding Partners. Steven's been there for over 17 years and has a real passion for providing advisory, accounting and taxation services. But most important for today, he has expertise in business valuation. So welcome, Steven. Thank you for making the time.
Yeah, hi, Angela. It's great to be here, and I'm really looking forward to our discussion.
Yeah. So when we were looking at the idea of business valuation, one of the things we were discussing is that a lot of business owners only tend to look for a valuation when that idea of it's time to sell comes up. But you were talking to me about many other times when it is a very good idea to get a business valuation. So if you could just give us a taste of that before we dig down into some of those key questions that we know your clients have been asking.
Yeah, it's a great point, Angela. And waiting until you're ready to sell or planning to sell is a mistake because for most business owners, their business is their greatest asset in terms of being able to extract wealth over their working life and also for retirement. So not understanding their business's true value early on can be costly from a financial point of view for a variety of reasons. And that would include things like missed growth opportunities, missed opportunities for improvement and profitability improvement. Mm-hmm. So they're key there. Other things are not understanding or not being aware of all the internal and external risks in their business, and then not being able to mitigate against those. Not understanding your business's valuation could lead to poor negotiation position if you're looking at having to raise capital from existing shareholders or new shareholders, and being unable to make the right strategic decisions, such as do we need to go and enter into new markets or new products, look at mergers or acquisitions to expand and grow our business. That's what I'd call probably more around the financial side of who would like a business valuation. Other reasons could be down to tax requirements. So from the ATO's point of view, if there's related party transactions happening, transferring shares, restructuring, they need to be at market value. Otherwise, there could be some big penalties. Other reasons would be estate planning. Family groups are typically complex nowadays. Estate planning, succession planning, understanding the business valuation is going to be key to that. Also, resolving disputes with shareholders. Typically, you might have a shareholders agreement that was put in place a long time ago, and you might have a mechanism in there that might not be appropriate, might need to be changed. So understanding that, being ready for unexpected life events is key there. So I probably sum it up that not preparing, I guess, is preparing to fail. So getting that valuation early will help you be prepared.
And that classic line, which you just said there, if you're not planning, then you're planning to fail. The reason why it is a cliche is because it's got so much foundation and truth. So let's dig into the one specific area, which is someone who is contemplating selling their business. Getting an accurate valuation is absolutely essential. And I've certainly heard from the DFK advisors, do not leave it too late. 3 to 5 years is ideal. Anything less than that, you're going to be chasing your tail a little bit. But there are 3 real misconceptions or ideas that business owners may have in their head that we would like to extract and reflect on a little bit here. One of these is about the value of the business. The second one is about how much money I'm actually going to get from selling the business. And the third is what we were calling the silver handcuff effect, as in how long do you need to stay in the business? Would you mind breaking these down for us? Let's get started with my business is worth a ton and I want you to confirm it.
Yeah, so most valuations of privately owned businesses are going to be prepared on what we call a multiple of earnings method. So basically what that really means is my business makes $1 million a year, and the appropriate multiple for that is between 1 and 5. And so 5 times earnings being 5 times $1 million, my business will be worth $5 million. Or is it worth 1 times earning and therefore it's only worth $1 million? the big misconception out there is from a lot of business owners is my business has got to be worth 5 times at least because I know that Joe Bloggs sold down the road for 5 and my business is better than his. But there's a lot of factors that go into determining what the appropriate capitalization rate or earnings multiple is, financial and non-financial factors. So by getting your valuation done, you're going to then understand what the appropriate multiple is for your business, the drivers behind it, and then what you can do to improve it if it's not quite where you think it is. And that improvement time can take years. So you mentioned it earlier about 2 to 3 years, 3 to 5 years getting ready for sale. It does take that long because of all the factors that go into determining a business's multiple or capitalization rate.
So it sounds as though our business owners come in with optimism. On the other end of the scale, with an advisor, we have some caution because we want to get it right, and so we're going to meet somewhere in the middle. And it's better to know that sooner rather than later for the improvement possibilities that you've touched on.
Yeah, absolutely. And it's not a one-size-fits-all approach.
Yeah.
So every business is different. There's different methods of valuation, some industry-specific valuation methods as well. So knowing the nuances for your particular business is really critical.
Absolutely. Makes perfect sense. So let's move on to that second idea, which is, okay, so we've agreed on what that multiple is, and this is the likely ticket price when I sell the business. But how much is actually going to get into my pocket? Because there's a gap potentially between those as well. Could you unpack that for us?
Yeah, and I guess getting a valuation on your business doesn't necessarily mean that's the sale price you're going to get either. It's a bit like a residential property. You go and get a market value on that from an appraisal from a valuer, and then you put it on the market, and the actual price that someone's prepared to pay might be slightly different, might be higher, might be lower. And that's no different to a business valuation. So your valuation doesn't necessarily equal your sale price, and then your sale price, what you actually get to put in your pocket and keep, is going to be impacted by many things. Tax being a key one there. We want to look at minimising tax, not avoiding it, but minimising it where we can. So that takes planning. But then other things that will be taken into account or reduce those net sale proceeds. A business might have outstanding debts or unrecorded liabilities, such as employee entitlements. They're all going to get taken into account and taken off that sale price that you're expecting or might be expecting. And then there'll be transaction costs as well, advisors, legals, brokers, that's all got to get taken into account. So the price that you might have in your head, once you factor in all those other things, could be a little bit less, and therefore you might need to defer your sale if it's a retirement planning type of event that you're looking at.
So again, it sounds like when we have the information, the correct information at our fingertips, that really puts us in a much better position to make good decisions. That's what it's coming down to.
The information is critical.
Yeah, and it will really influence the timing as well. So starting earlier than potentially anticipated is a good idea. So this third misconception we touched on before we started recording was what I dubbed the silver handcuffs. So we've got the sale price. We know what's going to happen in terms of what's going to be in my back pocket. But can I get out of here? Can I leave now? Can I hand over the keys and run away to a tropical island and retire? Not necessarily. Could you talk to us about that?
Yeah, and that always depends on the business and the agreement and things like that. But I'll dub it also the post-sale valuation or post-sale performance. A buyer is going to come in, and if they're going to buy it based on a certain level of earnings, they're going to expect that level of earnings to continue. So they are going to handcuff you in a little bit or handcuff someone in to be there, to stay on for another 12, 24 months, whatever that might be, to hand the reins over if that's required. Or they might structure the deal that there's an earn-out or a performance-based payment. So you might be getting the proceeds over multiple years. And if you don't hit the hurdles that you've sold the business on, or the business doesn't achieve the results that you said it was going to achieve, then the buyer's going to adjust the purchase price and you're not going to get what you expected or what you're hoping for. So being ready for sale is critical, and really understanding your business and what it can do is very important to be able to then achieve what you want.
And this is where having that outside perspective, somebody that can be realistic, somebody that isn't within the business itself, and so I can have a different lens to be viewing it through, is exactly why we bring advisors in. It's not necessarily that, as you were saying, we need a chartered accountant. There's other people who can also help with the valuation of the business, but it sounds to me as though there's many pieces there that an accountant can certainly help with.
Yeah, and most accountants will have an idea. There's back of the envelope calculations because the methods are well known, but you do want to speak to a business valuer. The chartered accountants have business valuation specialists. Go and speak to a business valuation specialist, not a broker, that really understands the metrics behind valuing a business. That way you will achieve your maximum value, and then you can get the guidance early on.
Okay, so advisor first, then broker, not the other way around. So if a business owner listening now goes, okay, I'm on the cycle of moving towards a sale, I could get a valuation, and I'd like to know the key levers that would have the biggest impact on improving the valuation.
Yeah, different for every business, and there's a huge range of financial and non-financial factors that are going to influence a business's valuation. But it might be, for example, your financial reporting is not up to scratch. You can't produce timely and accurate data. So that would be an area that then you need to go and focus in on to have that resolved. Understanding your industry trends. So there's huge amounts of change going in many industries now with technology and AI. So are you ready to capture those changes and take advantage of them? If not, you need to start doing things. Otherwise, you will get left behind.
Yeah.
If you're looking for growth opportunities, at most businesses, your staff are going to be your greatest asset. So are you putting enough time and effort into your staff development and creating a culture that allows the employees to thrive, and they are effectively going to take care of your business for you? What other opportunities out there from a growth point of view? Do you need to reinvest in plant and equipment? Look at new premises, R&D opportunities. So they're the things, again, will be specific to each business. Risks that are out there. Everyone's susceptible at the moment to cyber security and cyber attacks. So do you have good protections in place from an IT point of view? Do you have cash reserves to protect you from a downturn in the business cycle?
Just a few that could be on the tip of the iceberg, but those are great starting points just to get the grey matter thinking about actions I can take immediately. I know as we come to a close on this particular episode that we have a 10-question business valuation scorecard, which is sitting on the DFK Gooding Partners website. We'll put a link in the show notes for people to be able to access that. Is that, in your opinion, a great place to start before you then go into those first conversations with someone to do the official valuation?
Yeah, it is a great spot because it covers off probably the 10 key areas that we look at from a risk point of view that will then help us identify what the areas are that we need to be focusing on. So it's a great starting point. It only takes a minute or so to complete that survey, and then that gets the conversation started.
Excellent. Okay. Well, I think that we have got some good starting points there for our listeners to take action on. So thank you so much for your time, Steven. It's great to get your insight for our podcast listeners.
Yeah, thanks, Angela. It was great.
And to you, our listener, I will put that link into the show notes for you so that you can go and take that 10 question assessment. I hope you have enjoyed today's episode, and we look forward to your company again on the next episode of Less Than 15. Take care. We hope you enjoyed this episode of Less Than 15 and have a fresh idea or two to take action on. Hit the subscribe button so you catch every bite-sized business bulletin. And we'd love you to leave a review or perhaps share the episode with a friend. Less Than 15 is brought to you by Accountants and Business Advisors DFK Australia New Zealand, helping business owners make better decisions through local knowledge, national connections, and global reach. We'll be back next week with more valuable insights to help you and your business grow.